Good afternoon, everyone. This is Carl Meyer with Abundant in Houston, Texas. Today, EY, a large accounting and consulting firm, had an announcement. They had three parts to their announcement. The first was that they were not going to pay seasonal bonuses to their staff, as their staff are what they sell, and it's how they bring in their money. That's a big deal. See what the reaction is from their staff. The second part is that while they're not paying the bonuses, they are planning to hire 220,000 people in the coming year. Seems like a large number, especially given that they've just chosen not to pay their bonuses. The third piece is they're considering breaking the firm into two parts. EY is an audit and then tax and consulting firm, and that's the way they're talking about breaking it. So that's a very interesting change in their business model. They've been a combined audit, tax, and consulting firm for approximately 100 years, so a very long time. So why would they not pay the seasonal bonuses to their staff? Could be a number of reasons. Could be that with the war in Ukraine, that their European operations are slowing down. Maybe there's slowdown in payments on their collections from their clients. It's a possibility. East Asia, China seeing the COVID lockdowns, that's hurting business in not just China, but also Korea, Vietnam, other parts of East Asia. The US is potentially going into a recession this year or in 2023, so that may be a consideration. Those are all possibilities. The other thing to consider is that by breaking the firm into two parts, there may be a financing transaction that happens as some partners buy out other partners, and there may need to be financing for that. And that's very commonly the way it's done. There's some debt that's borrowed to buy out one set of partners from the other. They may be bringing on new partners as they do that, who would also require debt. And given the rise in interest rates and the challenge of getting capital, it's becoming the price of capital is going up with interest rates going up, and the availability of capital is going down at the same time. So it may be that it's harder to do that financing at those higher interest rates, and the firm may have chosen to not pay those bonuses in order to help finance that buyout. Now, the buyout still has to be voted on by the partners, so we don't know whether that's going to happen for sure or not. But it may be that they're planning ahead, considering that they need a certain amount of cash to make that transaction happen. So that's a possibility. How does the hiring impact this analysis? Well, one of the things that could be happening is simply that you've got regular turnover. EY has many, many employees, and they naturally turn over. The first 2 years, staff, approximately half of the accounting firms, typically about half of the staff in the accounting firms turn over in their first 2 years of employment as they come out of school at a junior level. Higher level employees may stay on longer, but part of it is going to just be a normal hiring process to keep the same number of people. Could also be that as they're looking at splitting the two pieces of the firm apart, the one side needs to, probably the consulting and tax side, which is a higher value add type of service, would be looking to grow so that they could finance the buyout. They need to grow so that they can have better projections, help with the lenders financing the deal, make their financial ratios look appropriate. So it could be that this announcement is really targeted at the financing aspect of this transaction. The cash from not paying the salaries, the larger numbers of hires would increase the projections for revenue into the future and thus profits, and that might make the lenders more comfortable doing the buyout with one set of partners buying out the other set of partners. So how does this fit into the world economy? Again, we've got a labor shortage going on, so very risky not paying bonuses. We've got inflation, which also makes it hard on labor to not get a bonus. Could also impact their cash flow because of the changes in the timing of cash coming in. We've got higher capital costs, which makes it more difficult to accomplish these types of transactions, very large transaction, and the cost of the capital, the interest rate can have a big impact on that. And then the supply chain breakdowns that we're seeing, particularly in Europe and East Asia right now, can have a big impact on the growth of those regions and thus large firms. So we're seeing EY, a big leading professional service firm, looking at their business model and making a change. Smaller firms may also want to do the same thing, take a look at how their business model fits in the changing world economy and how they can adapt.